Hi, in this video we'll introduce a new asset class which is called derivatives. So the name comes from the fact that the value of such asset is derived from its underlying asset. So what could be the underlying asset? It could be virtually anything. It could be something we have already learned before, like stocks or bonds. It could be a physical commodity like livestock, crops or metals, or it could be derivatives themselves. So you can create derivatives with underlying assets of other derivatives. Okay, so in this session we will only introduce the most basic form of derivatives, which is called the forwards or forwards contract. So imagine there's a rice market and there's a single buyer and there's a single seller here, and they make an agreement or a contract, and they agree to exchange 100 tons of rice in 3 months' time at a pre-specified price that is £100 per ton. So this is basically a forward contract. Why? Because it is settled in the future, which is in 3 months' time. And we have a pre-specified price here, and we name this thing the forward price. Okay, so this is the forward price. And we use the notation FT here, and F means it's the forward price, and T means it's settled in T years or T months or at time T in the future. In this case, it will be 3 months. Okay, so which one would benefit from this forward contract? It would depend on the actual price or the actual market price in 3 months' time. So 3 months later, let's suppose that the spot price or the actual market price in the future is exactly the same as your forward price here, which is £100 per ton. So would any of these parties benefit from entering this forward contract if we ignore the discounting or time value of money, in this case for just 3 months? So we're just comparing the purely numerical numbers for the monetary values here. So they wouldn't make any losses, nor would they make any gains. Why? If the buyer deviates or defaults from this contract, then he has to buy that 100 tons of rice from the market at the same price. So there is no benefit. So there's no improvement. And it's the same for the seller. If the seller deviates from the contract here, then he has to sell that 100 tons to the market at the same price. So there is no benefit either, and he cannot make any profit, or he will not make any losses from that either. Right? So the payoff for the both parties would be 0 in this case. Right? So now with that logic, what happens if the spot price in 3 months' time increases to £110? So as the buyer here, he would make a gain from this forward contract. Why? Because if he decides to deviate from this contract or to default from this contract, then he has to buy that 100 tons from the market at £110 per ton, which is higher than what's been specified here, which is the forward price. So if he honors this contract, and if the seller also honors this contract, then he's going to pay a cheaper price. So essentially, he gains from this forward contract. And the amount of gain is going to be 110 minus 100 multiplied by 100 tons, which is the size of the contract here. Okay, so that gives you £1,000. And that's the gain for the buyer. And similarly for the seller, now he's worse off if he honors this contract. If he carries out this contract, then he could have sold that 100 tons to the market and at a price of £110 per ton. But now if he honors this contract, he does not deviate, then he has to accept the pre-specified forward price, which is £10 lower than the market price. So he makes a loss in this case. That will be 100 minus 110 multiplied by 100. Again, that's the size of the contract here. So that will be minus £1,000. As we can see here, the gain for one side is exactly the loss of the other side, right? So naturally, we would discuss what if the price or the spot price drops to 90 or any price below 100, then in this case, the buyer makes a loss because he could have bought the same amount of rice from the market at a cheaper price. But now if he chooses to honor that contract, then he has to pay the forward price, which is 100, which is higher than 90. So he makes a loss in this case. That is 90 minus 100 multiplied by 100 tons, and that gives you minus 1000. And similarly, the seller will now make a profit or make a gain from this forward contract, because he could have sold that 100 tons of rice to the market at a lower price, but because of this contract, he can now sell it at a higher price. So the gain would be 100 minus 90 and multiplied by the size of the contract, and then it gives you 1000 here. Okay, so this is basically how forward contract work. Okay? Forward contracts would work this way. There are two parties and they both enter a forward contract, so that's a bilateral agreement, and there will be no cash exchange when they're entering this contract. So right now they're not paying each other anything, and this is only going to be settled at maturity. In this case, 3 months time. It could be any other different period, half a year, 1 month, depends on the agreement itself. And they always would have a pre-specified price, which is the forward price in this case. Okay, so with that in mind, we could potentially graph the payoffs, okay, for both sides. So for the buyers, or for the long position here, we have talked about this from the stock, from portfolio management, right? So if you're buying an asset, we call it you are in the long side, and if you're selling, then you're in the short side, okay? So, or in the short position. So we'll be using these two terms more frequently in the future. So for the long side here, your payoff would be on the vertical axis, and we've seen that your payoff would be dependent on the price of your underlying asset, the spot price of your underlying asset, and there will always be a pre-specified price, which is your forward price. In this case, that's £100 per ton, and let's call it FT here. Okay, so the payoff is going to be positive if your spot price is higher than your forward price, and negative if your spot price is lower than your forward price. So if we try to represent it here, that's going to be an upward sloping straight line here, right? And for the short position here, okay, if your payoff is on the vertical axis and your horizontal axis is the spot price, then our payoff is going to be, let's change it a little bit. So here, a downward sloping straight line here. Okay, just move it a bit so it crosses that point here. All right, so that's going to be the payoff for both positions. And for this case, the slope of this straight line is going to be 45 degrees. Why? We're assuming that payoff is on a per unit basis. So the contract size is standardized to 1 here. So in our example, the contract size is 100 tons. So we would multiply this by 100, but if we're trying to represent the payoff on the graph, most likely we'll be standardizing it onto a single size or a size of 1 type of contract, right? So that gives you the 45-degree line here. And as you can see, this corresponds to our numerical example as well. So if the spot price is higher than your forward price, then the payoff is positive. If the spot price is lower than the forward price, then the payoff is negative for the long position, and that's quite the opposite for the short position as well. Okay, so this is the basics for the forwards, and you should know how it works and which one gains and which one loses out. Okay, and I'll see you in the next video.